would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whiteline. I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Quite a few interesting little tidbits of information coming across today. We have another big name in the real estate world telling us to not worry about real estate. No bad things coming. We'll talk about that. We've got some other interesting things also that this all kind of comes together nicely today. So we'll see how this potpourri of real estate news all fits together by the time we're done. Of course, the absolute best way to reach out to me is through the website at therebelbroker.com. Once you're there, you can click on contact in the menu bar and send along any ideas, suggestions, or observations that you might have. While you're there, why not click the big red button at the top of the page titled Take the Survey to Support the Show. Once you do, you'll be asked a handful of demographic questions in your email address. Just make sure to use the same email address both times you're asked. Why? Because if you do, you will also be entered into a drawing for a $50 Amazon gift card, which we do here at the beginning of each month on the show. We've given away $550 total so far, and we'll be doing another drawing in the beginning of August. So get yourself over to the website, click that button, answer a few little questions, and you're helping me out. You're helping me achieve one of my goals I've had on my to-do list now. We're going on about 18 months, and that is to grow the show, expand it to the point where I can start investing more time in the show, providing you different kinds of content via different means and kind of enhance just overall what you get out of the show. So jump on over and take care of that. I'd be forever in your debt. And to show my appreciation, I'll be putting you into that drawing for that $50 Amazon gift card. Now, one more thing you can do is join the Rebel Underground. It's very easy to do. Just take your cell phone and text the word Rebel Broker to the number 44222. That's text the word Rebel Broker to the number 44222. Or if you prefer, in the show notes for today's show and just about every other show going back for months now, there is a link that you can click for you to enter yourself in or add yourself to the Rebel Underground list. And that's going to get a little bit more interesting moving forward in terms of exclusive access to content, interesting intros to things. And I'm also looking at a couple of other things that I think will be interesting. I'll give more details as soon as I've pinned that down. I find that it's doesn't make much sense for me to share what's bouncing around in my head until I've actually got a more firm grip on exactly what the plan is. But I absolutely want to expand what I'm offering, and all of this is hopefully going to culminate with that. Okay, so let's go ahead and jump in. I guess we'll start with, what we could call the good news. Now, this is coming to us from CNBC. JPMorgan points to low risk of a U.S. housing correction. We covered yesterday what the folks from Case Shiller were sharing via the Housing Wire folks. According to these folks, JP Morgan's research found that sharp price corrections have been relatively uncommon, even following large price increases. The research comes as fear grows over a housing bubble forming in the West, particularly in countries like the U.S., Canada, and Australia. On Monday, the National Association of Realtors said that U.S. home resales volumes had fallen more than expected in June. And because we know what we're talking about, right, because we don't just throw out isolated data, we know that the reason why that's true in terms of volume of sale has gone down is simply a inventory question. So that's really all that is. The only reason we have had volumes low is because we haven't had enough homes to sell the folks who want them. The article goes on to say that new research from JPMorgan examining historic data found that the risk of a dramatic decline in prices is low despite current fears, using data from 14 developed countries dating back to 1950. And that's great. they found that sharp price corrections have been relatively uncommon, even following large price increases. And I get that. But the problem is that you have to take into account the circumstances that generate all of these various problems and that build them up. What feeds the fire that creates a bubble? And there's a variety of different things. We've talked about them here on the show. And yesterday we covered them. I don't think we need to spend much time on this because the same reasons why they were wrong yesterday, or why I believe they're wrong, is just the same circumstances don't exist. The same things that are causing an up and or a down are different. Way back in the 1950s, it was far more market-based. There was huge demand for homes. The World War II had ended the decade before. A lot of folks coming home, finding wives, starting families, or husbands, right, for any women that were off serving, and coming back and settling down and jumping into that whole suburban lifestyle that was the hallmark of the 1950s. That was a honest-to-God, real market demand scenario with no artificially weird stuff preventing homes from being made, no bizarre regulatory influences into financing, trying to push getting money into more people's hands. It was if you want, unless you want to talk about VA loans. I mean, I guess we could make a slight argument there, but even that wasn't financially irresponsible. There were still standards that had to be met there. We have a completely different dynamic now. We have a system that is affecting our world of finance and housing that is just kind of weird. On the lending side, it's about feeling good about getting money into as many people's hands as possible. At least I think that's the friendly way to put it. I think the real way to put it is that there are an awful lot of folks in positions to pass regulations relating to financing that realize that banks succeed when they loan. They have to loan money in order to make money. And so through regulatory emphasis, they are trying to make it possible for them to lend more money, despite the fact being a factor that would contribute to things getting worse, not better. On the other side, there, I think, was this storm of states, counties, cities that really wanted to shove their hands into the pockets of builders during the uptick, during the surge that we had going from 2000 up to 2005, 2006. And none of those things went away, right? So all of the amazing success that fostered the greed on the part of cities and counties and states that made certain rules and regulations sound like they made a lot of sense. And believe me, the number of rules and regulations that were enacted between 2006 or 2005 and 2008, or going back to 2000 up to 2007, ridiculous. It's you want to talk about a hockey stick of a graph. The regulations and costs associated with them skyrocketed in that time period. And those things all still exist. So that's why we find ourselves in a position where buyers are sort of builders are artificially suppressed when it comes to building properties. All right. So all of that's going on now. Now, these are all things that really didn't reach their peak in terms of just stupid interference until 1994, 1995, as I mentioned yesterday. So if you want to get more details and all that stuff, go listen to yesterday's show. But I think that the fundamental problem is that they are basing their statistical analysis without understanding the circumstances of what made those markets what they were back in those previous marketplaces. Next, let's see, where should we jump to next? We got some good news. We got a blend of different things. One of the big things that I think is a huge takeaway from today's show is going to be a region of the country that I think should kick any investor in the butt in terms of reevaluating their investment strategies if they're talking about investing in these areas. We'll get into that. I think that'll probably be the last story that we cover today, but I think it's a big one. I like sharing stories that I think should kick off research on the part of investors, whether it's to take advantage of this as an investor in terms of advancing a new strategy to acquire new properties, or as a warning to current investors who are invested in these markets you may want to look at a way to get out of here because there looks like darker times on the horizon for these areas. And this is a gigantic part of the country. So we'll talk about that a little bit later in the show. But next, let's take a minute to talk about new home sales. They continuing their upward course in June, and Housing Wire saying that home prices are declining. Now, I am going to suggest that you check your local market because this seems to be a very community-based thing. Now, if we look at all of these sales in Santa Clara County, for instance, and we obviously don't have all of the data for July, but just the countywide. So not even cities. If we just go with the county, and I'm in that county, all of Silicon Valley pretty much is in Santa Clara County. That is not the case. We have not seen a drop in average price. Now, we don't have all the numbers in yet for July. Now, and what the source I'm looking at is the real estate agent source. It's the MLS. Not everyone has access to this. And for the month of July, the average is 769,157. That's the numbers so far. But we do have enough days left that may or may not continue to become that number, but it's almost exactly on par with June. So I guess the most optimistic you could say that in my market, it appears to be flattening a little bit. In June, it was 773,190. In May, it was 762,693. In April, it was 742,008. So it's been steadily going up since January of 2017. What's interesting is we saw price declines from August of 2016 to January 2017 pretty regularly. It was at its lowest in January of 2017. If you look at the countywide numbers, and that covers a huge area, it's almost entirely urban from one end of this county to the other. So there are obviously some not so urban areas, but the vast majority is very, very densely populated with San Jose, Sunnyvale, Santa Clara, Cupertino, a lot of those communities we've talked about. So even here, we're not seeing that on a month-to-month trend, and I don't think we can call July yet. It wouldn't surprise me if I ran these numbers once the July numbers are officially closed. It is higher than it was in June. But then let's look at my local area. If we look at just the numbers from my zip code, 95037, which is Morgan Hill, California, prices are ridiculously up. Not just a little up, but a lot up. If we look at what we've got so far in July, the numbers we're seeing for July are at $1,136,157 for the month of July in Morgan Hill. Now, that could go up or down before the end of the month, but it blows away June, which was an average of $955,219. The month before that, May, 907,000. In April, 846,000. Now, what's interesting about Morgan Hill is that was actually the lowest point going all the way back to August of 2016. We've had a little bit more fluctuations, and that simply could be Morgan Hill is obviously a sub-market. It's a much smaller market. The total volume of transactions is much smaller. So in the case of this time frame, there's only 491 listings that are part of this calculation just because the volume is so much lower. But that's the important thing to keep in mind is that the trends that we're seeing, the up and down prices are very much focused on these smaller areas. So you're going to want to figure this out for yourself because I think things like this, understanding what direction prices are going, is going to be a major mover for you in terms of deciding what's the smart place to invest. I mean, if you can figure out what the trend is, that's going to be information for you to move forward and make good choices. All right. So, and of course, this is new single-family homes. So that's what they're talking about. Sales of new single-family homes in June increased to a seasonally adjusted annual rate of 610,000. That's an increase of 0.8% from May's to 605,000 and up 9.1% from June of 2016. The median sales price of new homes sold decreased. So maybe, I'm talking about total homes sold regardless of new or existing. So keep that in mind as well. But also remember, we've been talking about this for a long time. New home prices have been completely out of whack with reality for a while. We've talked about how new home prices tended to be 25% above the price of an existing home in the same market with the same amenities. It used to be 6%. 6% was the normal. Now that's been around 25%. So anything that we see as a drop is really just slouching towards a quote unquote more normal number. So the median home sales price of new homes sold decreased to $310,800 in June, down from $345,800 last month. The average sales price came in at $379,500. So here's my takeaway from that number. New home builders are not reducing the prices of their specific homes. What they're doing is simply building homes at a lower price point. So that's why this number moved down. We talked about this several months ago, where we saw that there was an increase in the number of builders that were pushing to build homes that fit into the more affordable category. So I think all of that fits in. Now, some articles that I'm reading, I'm going to give you one that really just kind of gives you the numbers if you want to check it out at Rebel Broker, therebelbroker.com to get the article I pulled this from. But I think a lot of headlines we're getting relating to this data from other outlets is trying to push this idea that things are getting more normal. And I guess in terms of what builders are doing, at least they're moving more towards where the demand is the highest. But I don't think the implication that they're making, I don't think, is true in a lot of other articles in terms of things they're trying to get you to believe in terms of robustness and those types of things. Now, we're going to go ahead and cover another interesting home builder story in a second, but don't go away. We're going to cover that right after we take a quick break, so don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We're continuing on with our coverage of some new information that's come out relating to some buildings. We talked a little bit about JPMorgan's opinion that we're not heading for a bubble, and more power to them. I hope they are right. I would simply argue that the context of the markets is really a lot more important right now than it would have been when looking at big jumps in prices in the 50s or the 60s or the 70s. There are simply things in place now that weren't part of the equation then that I think are actually what play a huge part in why things get screwed up so badly. But we also talked a little bit about new home sales. Those have gone up, and prices on them on average are down, which I think simply reflects the kinds of homes that are being built, not an actual reduction in the prices, just building things that are priced lower to begin with. The other headline that I think is interesting to note today is home builder D.R. Horton starts building more homes after strong third quarter. Now, I'm actually surprised it's taken this long. One of the things I've been telling you for over a year and a half is all we need is one or two builders to get out there and do some building and see that this stuff will sell, and then suddenly other builders will jump in. Everyone will see money's being made, and we'll start seeing more homes getting built. It is amazing to me that it has taken this long, and maybe I'm simply amazed because of where I live, and it seems like such an obvious proposition, but I also live in a place where building is a huge pain in the butt. I mean, you'll remember the interview we did a couple of weeks ago with Dean Sukas. I would suggest you go re-listen to that interview, or if you haven't listened to it, man, go back to the site. Go to therebelbroker.com. There's a player right there at the top. Within the player, you can search on his last name, Sioukas, or you can do a general search within the entire site. That search bar is a little below that and to the right, and pull up the show notes for it and play it through that if you prefer. But this is what he does, right? One of the things that's in his absolute wheelhouse is being right here in California. He's up in Sacramento, and he is a developer. He's a guy who finds the land, puts things together, gets a lot of the stuff going for development. And in our conversation with him, not a lot was happening. And one of the reasons I think that's true is because it is so freaking hard to do it here. The regulations are such a huge burden. I think a lot of builders just don't want to deal with it. When they sit down and do the math, they think twice, and we need to create an environment where that isn't the case, where builders are enthusiastic about meeting the needs of shoppers today. But the good news here is that home builder D.R. Horton, and more, obviously we're talking about a variety of markets. D.R. Horton is in a bunch of different markets. They posted steady growth in fiscal 2017 third quarter as the market waits for an increase in housing inventory. According to the home builder's earning report, it's well positioned for the fourth quarter and to help bring more housing inventory to the market, which is a great piece of news. They talk a lot about the number of homes. Really, some of the most interesting stuff here is not its income, but its number of homes built. Home building revenue, homes closed in the quarter increased 16% compared to at over 12,000 compared to 10,700 homes in the prior year quarter. The earnings state that its sales order backlog of homes under contract at June 30th increased 3%. In addition, the company's homes in inventory at June 30th, 2017 increased 9% to 27,600 homes compared to 25,300 homes. So they've got more homes out there. I'd really love to hear where are their biggest developments. I'm sure if we went to their website, it would tell us that. The report also sheds some light on Home Builder's recent acquisition of 75% of Forestar's outstanding shares. Forestar is a residential and mixed-use real estate developer. It's a strategic relationship between D.R. Horton and Forestar will significantly grow Forestar into a large national residential land development company. That's kind of encouraging. When you see a building company that is expanding in this way, in other words, acquiring a company that does what Dean Sukas does, which goes out there and does development for properties so that builders come in and start building, that is great news. I think that shows a level of enthusiasm on the part of them as an organization that they're going to push forward with more projects that will supply the demand that is so unmet right now. Now, one thing I do know about D.R. Horton is they do build in my area. I've looked at homes in the Bay Area. I have frequently talked about D.R. Horton homes here, but they are all over the country. I'm seeing Washington, Oregon, Nevada, California, Hawaii, Arizona, one in Utah up in Salt Lake City, one in Minnesota and Minneapolis, Phoenix and Tucson in Arizona, New Mexico, bunches of stuff going on in Texas, Oklahoma, Louisiana, Mississippi, Alabama, Georgia, Florida, South Carolina, North Carolina, Tennessee, Kentucky. Or no, that's not Kentucky. That's Tennessee. Nashville and Knoxville and Huntsville, West Virginia, Maryland, Delaware, Pennsylvania, and New Jersey. We'll be talking about that area in just a minute. So they're all over the country. In Colorado, tons of stuff going on in Colorado, Fort Collins, Boulder, Castle Rock. So they're out there making it happen, and it's just good to see a builder of this size out there creating more homes and more communities. Now, they've got 13 available communities going on in California, and obviously my bias is there. I apologize. But they have one here that I actually think I've looked at these called Calle Siena. In Morgan Hill, that's our town. And you know what? I haven't because I don't think they're built yet. But I keep getting emails. Right? They keep showing up in search things that I'm doing, and the pictures are always just computer renderings of what they're going to look like. So not really available, I think, for viewing just yet. But here was the problem that I talked about with them before. So of the ones that they have a price on. And the ones I'm looking at that have prices associated with them are right kind of, they've got residences that are ranging in size from, let's see, 2,000 square feet up to almost 4,000 square feet. But their priciest one here is 4,000 square feet, and this is the one they'll tell you about. They actually have 3 floor plans where they won't even tell you the price. $1.5 million. The next one down at 2,979 square feet, 4 beds, 3.5 baths, $1.242 million. Next one down, 2,650 square feet, $1.179 million. 3 bed, 3.5 bath, $961,000. So these are all not aiming at the entry level person, unless these other ones that probably aren't built yet. But these are all similar sizes. All 3 of the ones that they aren't giving prices on are 4 bed, 3 or 3.5 bath homes, ranging in square footage size from 2,467 square feet up to 3,190 square feet. So if these other homes are any indicator, these are all going to be million plus, $1.1 million homes. So definitely not stuff that is working for us in terms of getting more affordable housing into the hands of folks. So, and I think this is a California dynamic. Whenever I look at D.R. Horton and other states that aren't quite as smoldering in terms of the amount of costs and regulations that are involved, they tend to be participating. D.R. Horton's known typically as a company that tends to jump in there and satisfy demand at a lot of different price points. So I think this kind of stuff shows it's just really hard for them to do that here in California. All right, so you can check that out. I'll include a link to the D.R. Horton website so that you can get an idea. It's actually kind of a cool map, and I'll be happy to share that with all of you so you can see it and maybe find developments near you. And for those of you who are investors, knowing if you're doing buy and flips, knowing you're competing with these is a good thing to know, and you can use it as a gauge of not what you should be selling for, but as above what would be the max price you'd get for a similarly appointed home. Because these should all be priced more than what you would ask for, unless for some reason on that market you could get the same amount. But I doubt that would be true. All right. In other news, we're already towards the end of the show here. The Fed elected to hold off on interest rate hikes. And they're still saying to expect something in December. So let's think about this for a minute. All of the interest rate increases that the Fed has put forward so far have each been the absolute smallest they could do. And one thing we talked about was they had to raise interest rates, if nothing else, for political reasons to show how much faith they had in the market. Because of the really small increases, the 0.25 basis point increases, which is basically a quarter of a point, increases they've done each time they've done it, that's been a pretty weak demonstration of faith. Now, they've decided not to increase interest rates even by that feeble 0.25 basis points. Mortgage rates stand at the lowest point they've been in a very long time right now, which didn't result in an increase in mortgage applications. And I've said this before, and it's another one of those, I hate it and I love it when I'm right. The interest rates where they are right now, wherever they're going to fluctuate within this range, within this 0.5% range of where they are now, has absolutely nothing to do with why mortgages are or are not being underwritten. Maybe refis. We can have an argument about refis, but it is inventory. That is it. You could raise interest rates quite a bit more, and you would still and the number would increase if inventory increased. You could reduce it another point, and that still wouldn't increase the number of folks getting a mortgage unless they're doing refis. The reason is because there is no inventory. Now, you might see a bit of an uptick because suddenly folks could afford more house, right? They could buy a house with more money and now have a slightly lower monthly payment. Their debt to income ratio per month would fit now with more homes. So I guess you could make that argument that if mortgage rates went down even more, some segment of folks would be able to do that. I think that would be ridiculous and crazy, but there you go. But this shows I think, through action, don't pay attention to what they say, but this shows a fundamental lack of faith in things moving forward and a continuing interest in defending the ability of the stock market to earn. Then this isn't even supposition, right? This isn't even conspiracy theory stuff. There's no tinfoil hats required. The Fed has come out and said, Yellen has come out and said under oath, the reason we do this is to protect, one of our jobs is to protect the stock market. So that's one reason why we've kept interest rates so low for so long. It's not even conjecture, right? Go ahead and you can Google that. So if they are worried about the stock market, it sure would be logical for them to stop the increases in interest rates. And I think that November or December would absolutely be the very first time they'd think about doing it, simply because they'd want to get through October. I continue to think bad things are going to happen in October, and I think that as a result of that, we will not see an increase in December. I think October, the stock market will take enough of a hit that the Fed will not raise the rates in December. So there you go. Let's see if I'm right. It's definitely a gut feel type thing. But if my October theory is correct, that the negative thing will happen in the stock market in October, I believe that we won't see that December increase in Fed lending rates. Unless someone finally realizes we need to stop worrying about the stock market. We need to worry about long-term health. So we need to take our medicine. We need to take the pain now, and then they'll raise interest rates. Don't see that happening, though. All right, so here we are where I would normally call it quits for today. Man, I always overstock my shows. Got to stop doing that. People are getting the hell out of the Northeast. That's the headline from the New York Post. And this is something I think anyone who owns property or is considering owning property in these areas as an investment should be very aware of. Last year, 3 states in the Northeast, New Jersey, New York, and Connecticut, landed in the top 5 places people were moving out of fastest, according to 2017 data from United Van Lines. And I love the United Van Lines data, by the way. We cover it every time it comes out. The other 2 states in the list were Illinois and Kansas, and data from Pew Charitable Trust found that while people are all about moving to the South and the West, the population growth in the Northeast is, quote, sluggish. The Northeastern exodus is particularly acute in many big cities like New York City. Since 2010, more than 1 million people have moved from the New York area, which includes parts of New Jersey, Connecticut, and Long Island, to other parts of the country. And so why are they doing this? And I think it's important not only to so for those of you who are thinking, I don't need to listen because I don't have anything in the Northeast, I don't want to buy anything in the Northeast. Well, understand what the conditions are that are causing this exodus. And this is something we talked about. We talked about this maybe 3 years ago. The one when we were first starting to cover the van line numbers in terms of where people are moving out of the greatest. And we specifically were talking about New Jersey, coincidentally, because I happen to have a client who was leaving here and moving to Jersey. It's not a coincidence that a lot of these areas also happen to be the areas with the biggest tax burdens. Data released on Wednesday by personal finance site GoBankingRates.com reveals that the number one financial fear of people who live in the Northeast is that they will have to live in debt forever. The Northeast is the only region of the country that ranked this as number 1. So why are people worried about it? Because there's a ridiculous amount of crazy taxes up there. And the cost of living across the region is among the highest in the nation. 3 of the 5 most expensive states or districts in the country, New York, Washington, D.C., Massachusetts, are in the area. The other 2 states are Hawaii and California. Coincidentally, the only 2 states I own property. Maybe I need to start having a think. Having to spend so much just to get by can make getting out of debt seem much harder, and housing costs and taxes in many of these states are also sky high. I actually had a client who just sold their house, got an awesome price for it. I actually helped them buy the house, so I kind of walked through the whole process of remodeling that they did for the year or 2 after they moved in. They lived there now for I think it's been 8 years. Anyway, they sold and moved out of the state. They're done. They're out. And a lot of it is simply because of how burdensome the taxes in California are. Weather, of course, plays into it. Jobs. Many companies are setting up shop in warm and less expensive places, which means that people pondering getting out of the Northeast can now find work. Texas, for example, has seen massive job growth since the recession. And some of these jobs are in fields you wouldn't normally think of as being in Texas. Google, Apple, Dropbox, and Oracle all recently built or expanded offices in Austin. And I actually worked at Apple when they put in the technical support group in Austin. I actually helped to train some of those folks back when I spent a little time at Apple. Because who wouldn't take a job at Apple if they offered it to you? A lot of lessons learned there, by the way. But this is way back in the early 90s when I took a little break. I went and did that for a little while. Never had to move to Austin. I was still here, and I actually still did real estate at the same time, but took a job with Apple because it just seemed like too sexy of an opportunity to pass up. So at that time, and what's interesting is at that time, Apple wasn't just considering moving their tech support operation to Austin. They were considering moving Apple headquarters to there. And then they decided that the PR part of it would be too bad, and Cupertino was willing to give them huge concessions, which they've done, which also led to the building of the giant saucer-shaped or circled the donut building that they're building over in that area. And then they stepped it down and thought they would simply move Apple USA to Austin and backed away from that, and then just moved one segment. If you think that Apple is not in some meetings considering moving, given how much it costs them to be where they are on a semi-regular basis, you're nuts. And I know there are tons of companies that have that conversation every year as it gets more and more expensive to do business in California. So anywhere that has those kinds of dynamics, ridiculous, crazy taxes. If you don't have something to offset it, right here in California, what do we have to offset the fact that we are taxed to death with all kinds of crazy stuff? Well, it's because you can start your morning skiing in Tahoe. You can do a little desert four-wheeling in the afternoon, and then you can sip margaritas on a sun-drenched beach for dinner. That could be a day in California. So California survives and thrives kind of in spite of the stupid things that the state does to its people, and more just because of the weather we have here and what's offered in that respect. So you don't have that in many places like New York or New Jersey. So I think that's one reason why we're able to get away with it, whereas other folks in these other areas are like, screw it, we're out of here. So kind of keep that in the back of your head and always be aware of migration habits. And for those of you in the Northeast, either now with investments or who are considering investing there, take a close look at that. See if it doesn't represent a better opportunity for you to focus somewhere else, or use this as a warning for you to potentially liquidate what you've got in that area and purchase in an area where you might be able to boost your return on investment. All right, folks, as always, I hope you have a fantastic day. Thanks for tuning in and spending your valuable time with me, and I hope I've given you a ton of value in return. Thanks for listening. I'll talk to y'all next time.